Good morning, everyone, and welcome to our DAT weekly market update. This is our first update for 2022. I'm Ken Adamo, Chief of Analytics here at DAT. New year, same three guys, just like ZZ Top, same three guys, same three chords. RIP Dusty. But I got Ned Damon here, Principal Data Scientist, and Dean Krogh, Principal Industry Analyst. Happy New Year, guys.
Happy New Year.
Yeah, Happy New Year, Ken. Happy New Year, Ned. Great to be with you again.
It's a new year. COVID's firmly in the rearview mirror. We have nothing to worry about. Everything, 2020, we just think back, and 2021. None of that stuff's going to ever happen again, right?
No downsides. It's smooth sailing from here on out. I'm going to board my ship, the SS Live Forever, and just...
all gas, no brake. I think what the kids are saying nowadays. So for those unfamiliar, or for those that have picked 22 to start tuning in, this is our actual third calendar year of doing this thing. I believe we started in 20. We join, we're here every week, 10 a.m. Eastern on Tuesdays, talking about freight markets, trends we're seeing, analysis, having guests on. No guests today, just us. But more importantly, answering your question. And a little bit of a spoiler alert, maybe a little bit of a tease. Towards the end of the show, we're going to be talking about your freight resolutions for 2022. So if you want to kind of get a jump on putting those in the comment or chat below, we're really interested to hear what you have as a freight or supply chain resolution heading into the year. So with that, I'm going to get us moving into the key points of the week because we have a lot to cover. So, spot rates are just crazy at this point for reefer and dry van especially. Now, I think Dean will caution you, and I'll kind of tee it up a little bit. For most charts and graphs, when we're trying to make them really pretty, we clip the first 1 or 2 weeks and the last 1 or 2 weeks of the year off, just because things tend to go crazy towards those last couple. You're paying a lot of excess holdover, holiday surcharges, et cetera, just something to think about. The load board was incredibly active, especially from a load to truck perspective over the last couple of weeks. And again, a lot of carriers had a really great year, taking well-earned rest. Wouldn't be surprised to see a lot of the bars and restaurants in Florida teeming with activity as truckers flee to the warmth to get a little bit of R&R. And then return season is underway. Again, as we talked about, supply chains in the e-commerce era have shifted a bit. The first 1 to 2 weeks of January, maybe even pushing this year into 2 to 3 weeks into January, still pretty congested with a lot of the returns that happen before things really slow down. So with that, I will turn it over to Dean to walk us through the update. Dean?
Yeah, thanks, Ken. Great to be with you again. I saw a lot of social media posts over the break of carriers, in fact, at beach resorts and all sorts of places around the country. Seemed to be more than usual, so hopefully they had a good break. But as we go to air, we've got a pretty big traffic jam underway in Virginia, in between Washington, D.C. and Richmond. In fact, there's cars been stranded for about 24 hours following a big storm yesterday, 12 inches of snow, 2 inches of ice. The message has gone out from the governor for any stranded motorists to call 911 but stay in your vehicle. Of course, a lot of people totally unprepared, 80 degrees a day earlier and then snow. So reports of people walking along the interstate in flip-flops, which would be normal for further south, but could be diabolical for those that are not handling it too well. It's a pretty big traffic area. There's another snowstorm coming in. So for those listening, this could be an event that it's worth watching. There's another snowstorm that's going to follow in behind and dump another foot of snow by the end of the week. This affects some of the biggest interstates in the country. I-95, obviously one of those, but 78 to 81 and 84 will be a pretty big area to watch. There's a lot of freight moves in that particular corridor, particularly out of the warehouse markets out in Pennsylvania. So let's start off our freight market update with a look at our load board activity in the dry van sector. As Ken mentioned, a lot of activity. Some of the volumes we're seeing in the load post area are sort of unprecedented levels for this time of the year. We're seeing about 70% more load posts compared to the same time a year ago. But with so many carriers taking time off, the load to truck ratio took off last week, spiked to its highest end of year level in 5 years, up to 10.41 loads per truck in dry van. Refrigerated market, a little bit tighter, ongoing shortages of products like cream and French fries, obviously driving demand in the temp control market as we start. So is the cold weather further out west for the protect from freeze freight. Spot market load post volumes up last week, The load-to-truck ratio jumped to 34.34 from 14.96, so more than doubled last week. In the flatbed sector, winter kind of arrived in full force over the New Year holiday, so it's no surprise to see flat to lower flatbed volumes this time of the year. The load-to-truck ratio moved up, though, because of carriers taking time off, moved up to 72.41. Having a look at our markets, on our market condition index, we'll start off on the West Coast. There's still no signs that port congestion off Los Angeles is easing anytime soon. There are still over 100 vessels waiting more than 20 days to find a berth. The net result for the DAT network is we see lots of truckload volume in major port markets still. There's around 40% of all the import volume comes into the West Coast. So I've been watching this for the best part of 12 months now. And on the long haul lanes where truckload competes with intermodal, particularly Los Angeles to Chicago, rates have increased to $1.24 per mile. They ended last week at about $3.66 a mile. We're also seeing triple the volume of freight on that particular lane as the intermodal network struggles to handle the additional capacity from the Trans-Pacific trade lane. Capacity is undoubtedly the tightest Los Angeles to the big warehouse market in Stockton. A lot of freight moves along that lane. Rates are up $1.10 per mile in the last 12 months. They're averaging $5.23 as of last week from Los Angeles to Stockton. Capacity is also tightening in the Midwest market. Chicago spot rates for loads to Elizabeth, New Jersey ended last year at an average of $3.77. That's excluding fuel. That's 35 cents a mile higher than the same time in 2020. And loads moving from Atlanta to Orlando, that's another lane I watch. There's a lot of volume moves, both dry van and reefer on that particular lane. Continue to increase on the southbound side to $3.98 a mile last week. That's about 80 cents a mile higher than this time last year. As we said earlier, a lot of reefer carriers taking time off, so we saw a lot of increase in spot rates, particularly out of Florida. Lane balance is pretty critical in the Florida market to avoid deadhead miles. A lot of carriers are reluctant to head too far south when there's not a good balance of freight. So we saw the state average for refrigerated spot rates increase 40 cents a mile last week. So I think the annual capacity crunch that we see this time of the year affected some of those extreme markets from a distance perspective. Outbound rates up to 261 out of Florida markets. But on some long-haul lanes, in particular the I-95 corridor where it's shut right now, loads from Miami to Hunts Point in New York up to 432. It's more than double the same period last year. 432 is excluding fuel. Loads to Boston jumped to 362 last week. They've been around $2 a mile since October. And a similar trend has been reported on the high-volume Miami to Atlanta lane, up to 301, about double the same time a year earlier. In the Southwest, we covered this on our show just before Christmas. There's a lot of volume starting to come out of the Winter Salad Bowl in Yuma, Arizona. A lot of our leafy greens come from there over the winter. Spot rates are climbing, paying $3.56 a mile for loads to Hunts Point, New York out of Yuma. And as a measure of how tight capacity is in regional produce markets generally, those particular rates to Hunts Point, New York for the winter salad is about 80 cents per mile higher than the monthly average a year ago. The other data point I've been watching to see when the market's going to start to cool off is Los Angeles to Las Vegas. Those rates are showing some signs of cooling down. They've decreased 42 cents a mile since the peak of $6.35 a mile back in November, currently averaging $5.93. So still lots of opportunity for carriers and brokers in particular markets, even though we seem to have hit a flat point in our national averages. Lots of opportunity on some of the volumes around port markets. Flatbed, after a record-breaking warmer temps in December, a lot of carriers kept pretty busy throughout a lot of our regions. In our number one flatbed market, capacity was pretty tight last week in Houston. Spot rates increased by 19 cents a mile to an average outbound rate of just over $3. That's excluding fuel surcharge. On our highest volume lane out of Houston, 270 miles north to Fort Worth, spot rates inched higher last week to $3.33. It's about $1.10 per mile higher than the same time a year ago. A lot of volume moves east to New Orleans out of Houston. Even though volumes have dropped 20% in the last 4 weeks, spot rates have also followed suit, down to 267 after being as high as 332 last September. And in the Dallas market, capacity remains pretty tight following 4 weeks of gains, up 14 cents a mile to 260 in the last month. Loads to short-haul loads to San Antonio particularly tight capacity. They're averaging $3.22. That's up 80 cents a mile since this time last year. So wrapping up with our year-over-year look at spot rates after a very profitable year. Lots of carriers are taking time off, as we mentioned. Spot rates surged last week. Again, not surprising. Next week will be pretty telling, being the first week of the shipping year in 2022. Rates are up 8 cents a mile again last week. That's up 18 cents a mile in the last 4 weeks. The average last week was $2.78. That stands 41 cents a mile higher than the same week when we started 2021. Having a look at the refrigerated market year-over-year chart, as you can see there, rates have increased by 24 cents a mile in the last 4 weeks. Another 8 cents a mile increase last week. The national average ended at $3.23 excluding fuel. We're starting off the year about 69 cents a mile higher than the same period last year. And wrapping up with our flatbed year-over-year views, flatbed rates have remained mostly unchanged in the last couple of weeks, up 1 week, slightly down 1 week the next. So not a lot of movement. They ended last week where they started at 267. Compared to this time last year, it's about 13 cents a mile higher. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly long form blog post. So that's it for my update. Over to you, Ned, for the short-term forecast.
Just as a reminder for everybody to get your freight resolutions, new freight year's resolutions in, because we're going to be talking about ours, and we'd like to hear from you what you're hoping for in the new year. Speaking of what I'm not hoping for in the new year, I'm not hoping that the short-term model is going to be correct. I think the short-term model here is absolutely being ridiculous. This is here, we're looking at the VAN short-term forecast, jumping the gun just a hair. In blue, you can see the market rates observed by DAT. In red, you can see our short-term model, which is expecting things to go off basically to the stratosphere with no seasonal readjustment back downwards. I don't think that's going to happen. I think that instead the ratecast model in green, which is expecting a correction downwards, although not a full sort of give up of the entire movement upwards that we've seen over the holiday period, is likely to happen. I would be maybe even a little more pessimistic than the ratecast model, but I'm going to caution you to look more at the ratecast model in these forecasts than the short-term forecasts. And then finally, in the blended forecast in gold and silver, we have mixtures of the two models, the short-term and the ratecast, in different amounts and in different ways. Ratecast, as a reminder, is our flagship model and does a much better job of handling seasonality than the short-term model does. Now moving on to the reefer forecast. In blue, you can see the market rates observed by DAT, including that very, very big jump over the holiday period. I'd like to pat myself, and by myself I mean the ratecast model, on the back a little bit for expecting this volume of jump. I certainly wasn't expecting it, but ratecast does a good job, surprisingly, and not surprisingly, I guess. But sorry, I'm trilling around. It's been a couple of weeks since I've done the show. In red, we have the short-term model, which is expecting continued upward motion. Again, I expect that not to be the case. I expect in the ratecast model in green, a strong downward trend, giving up most of the gains that we've seen over the holiday to be the case. And then the blended forecast in gold and silver are mixtures of those two models, leaning more towards the short-term model. But again, I expect ratecast to be correct. Finally, moving into flatbed, the flatbed motion over the holidays was a lot less dramatic, as you can see from the observed market rates in blue. The short-term model continues to believe that we're going off into the stratosphere. Again, I don't see that happening. The ratecast model in green is expecting, once again, giving up most of the holiday gains and settling down to a lower level. And then the blended forecasts in gold and silver are mixtures of those two models, leaning a lot more towards the short-term model. But overall, I really would strongly caution you not to look at those short-term models. The short-term models is basically reacting to the sustained holiday pressure and treating it as if it were a real overall price pressure and not a seasonal bubble. I really encourage you to look much more at ratecast, because ratecast has a much better understanding of seasonal patterns, of these kinds of long sustained seasonal patterns. And that's about it for the forecast. I can go into a lot more detail if people are interested, but that we can do during question time, because it's time for our IQ question of the week, which is, what are your transportation industry New Year's resolutions?
Well, what are they?
Ken, do you want to go? I can go first, or you can go first.
And why don't you go
Dean?
first, Ned?
My resolution is about robustness. My engagement with the freight industry is more at the data level than at the actual physical movement of goods. But I think that this lesson of something that I want to encourage in my modeling approaches applies overall, and that is robustness against unexpected outcomes. There's a lot of kind of unknowns in the horizon. There's a lot of things that we expect to happen, but we don't know exactly when they're going to happen. And so trying to build my models to have a lot more structure and solidity when unexpected events happen, so that they can react and we don't have to kind of treat everything as a brand new exercise in the unknown. Just making sure that there is a plan for this eventuality and that eventuality, and making sure that you're prepared, because there's a lot of uncertainty in the market in a lot of different directions, and trying to make sure that you have the capacity to handle that, to handle sudden price shocks upwards, sudden price shocks downwards, to handle if, Highway 95 gets completely jammed up with traffic going from 80 to freezing. That kind of robustness is my New Year's resolution. It's not very pithy. I'm sorry.
I have to unwind some personal robustness after the holiday break. What about you, Dean?
One of the sort of broader New Year's resolutions I'd like to work on is get a better handle on dwell time, at a national level. I think, one of the biggest factors I've seen in the post-ELD era is their inability to understand the impact of carriers waiting to unload and load. And again, there's examples every day, but a few years ago I wrote a blog post about adding a weight surcharge to the rate per mile for carriers, because the whole notion that we give shippers an hour and a half to 2 hours of free time to unload trailers is bizarre in the extreme, because that's where it just starts. It's not like, well, we'll do it within 2 hours. No, it goes much longer than that. And I think in the post-ELD era, drivers are paid, their road speed is very important, their average road speed over the course of a week. When they sit around on loading docks, they'll hit their 14-hour pretty quickly, and they'll bump up on their weekly limit without too much effort. Their miles are down. So I think there's a lot more we could do about trying to increase the efficiency. I've been advocating for a long time that we don't have a driver shortage. We have a driver velocity throughput issue right now, because the carriers are spending a lot of time on docks that have lack of staffing. And a friend of mine I was talking to just after Christmas. He spent 23 hours unloading potato products up in Maine last week. So I initially thought that was an outlier when it happened the month before. It turns out it's actually much more common than I thought, but it's hard to get a handle on this. Even though we've got ELD devices in our long-haul trucks, there's no real aggregated data set at a national level that can figure out how much this really costs the transportation industry. So I think getting a handle on dwell time would be the sort of the takeaway for me.
Yeah,
I guess that's like a perpetual resolution, I think. So I have two. I have a personal one, which I'll get like a personal professional one, like on our side of the industry. But I think from an industry perspective, I went back over the holiday. I know this is thrilling stuff. I listened to some of our early in the year recordings and some of what Dean and back when I was writing stuff, wrote some stuff. And we talked a lot about how year-over-year comps were going to fail you. And I mean, boy, was that true. I mean, that was probably truer than we even expected. I think we expected it for some different reasons. I think we expected the year to be this sort of summit in the middle, and then like 18, right?
Mm-hmm.
But we're gonna have on the ascent and descent, those year-over-year comps fail you, right? It's like a stopped clock being corrected twice a year. So, cutting to the chase here a bit, I think this is a year, and I don't mean this selfishly from DAT. I mean, looking at your own internal data, external market benchmarks, this is a year where you could get caught very flat-footed if you aren't very closely paying attention to market shifts. And I know that it's not as punitive when the market's going up, right? If you're not paying as close attention when the market's going up, you can dramatically undercharge and get burnt as a broker trying to cover freight. As a carrier, you don't charge enough. When the market's going down, the signal you'll be getting is you're missing opportunities, right? Price points that were securing freight before may be a lot less successful. or not successful at all. And so you might see your revenues dip or your shipment counts dip, or if you're tracking win rate on the spot market, that starting to dip. So I think understanding and having a very close, I mean, this isn't a market where looking 30 days back at your historical data, even looking a couple weeks back, is going to benefit you. You really need that freshest cut of what's happening out there to understand. And again, it's not just us. It's not just market weather, throughput data, weather, traffic data. Understanding what your own brokers, what your own operators, what your own call center folks are doing in a near real-time basis is going to be really critical to getting that edge in a down market. Because gamifying a down market is a lot more difficult, in my opinion, than sort of on the upside. Do you guys agree with that? I mean, what do you think? You've both lived through up and down market cycles in different industries.
I would say that having the recent data is very important, but I really feel like throwing away is too strong of a term, but you need to have that kind of deep bench of understanding of how things have behaved historically to be able to get a sense of what the new data is telling you. I do agree with the point that you made, though, about your own internal data being extremely important, because how you react and have reacted, I think, is the single biggest point of data that you can have. Knowing how your particular business and your particular neck of the woods has behaved is the most specific data that you can get, and it's a lot of times the easiest to collect.
Yeah, I mean, like I said, you think about like the best time to be in pricing or operations is when markets are flat. Like 2019 may have been a crappy year for a lot of people involved, but if it was nothing else, it was placid. Like your week to week, it was just more of the same. It was more of the same kind of junky market, but it didn't move that much. I remember it was a very easy year from a pricing perspective. It's what allowed me to go speak at a DAT trade show and ultimately get hired. And 18 was just incredibly difficult, right? Because you had the first half of the year, which was the staircase up, and then right down. I think people don't realize, or at least they lose the context of how hard the market fell in the second half of 18. And I just remember from my personal experience, adjusting to that market falling was a lot more difficult than adjusting to market. It's the same with the stock market, right? I mean, we experience markets plodding upwards for a lot longer portion of our lives than we do corrections or rectifications down. So I think it's something to be vigilant of as we head through 22. But we don't know what's going to happen. We have what comes after Omicron in the Greek alphabet?
I'm trying to remember.
Drawing the blank.
Yeah.
What happens when they get to Omega?
Do they do the hurricane thing and just like Omega Alpha?
Maybe they start naming it after. No, that's not a joke, but you get it. Yeah, and then this weather piling up. I mean, we don't know. This could be. Remember what kicked? Again, we were doing this show not quite this show. A couple weeks from now, we were talking about the market was in free fall. It was down 12%, I think, at one point.
Yeah.
And then Texas froze over. So, who knows? This kind of stuff is more localized, though. I don't know what you think, Dean, but it's not going to be as. I don't think either of these storms will have as big of an impact as an entire the giant state freezing and all but 2 freight terminals in the entire state closing and being without power and the entire grid shutting down. I mean, that was kind of.
You're not wrong, but there are not to be like a doom and gloomer, but there are some signs that there are some bad weather patterns forming over Texas. I know there was a big dip in natural gas output. Was it just a couple of days ago? Holidays are hard. And I would be careful. I think robustness is, as a robust gentleman.
Well, locally, sure. I mean, I think people on the West Coast are looking at this going like, oh, well, okay. That's what you chose to live there, right? When hurricanes, it's the same thing. So we'll see. I mean, I hope it's not bad. Dean sent me that picture this morning. I was having my coffee. I'm just like, whoa, where was that? It's just nuts. the pileup pictures. I'm sorry,
Yeah.
great radio here. Yeah, he sent me a picture of all the trucks just sort of without chains off the road and whatnot. It looked like a mess. So
Yeah, no one thinks about chains along the I-95 corridor.
No,
not down in Fredericksburg or wherever you sent it.
no.
But like you got a third US population in that particular area there, so it won't. We have to see how this week pans out. But there's a couple of interstates there that we've got to watch pretty carefully, especially out to 81, 78 to 81 in particular.
So before we get to our listeners' resolutions, when we have questions coming in, so feel free to drop those. We do still have 10 or so minutes. We'll hang around. I think as like where we sit in the industry, both DAT and collectively as this sort of intelligence providers, I think our resolution needs to be make sure that we're focusing on signal this year. I think that needs to be a guiding principle for us and others, is to say, there's a lot of ways you can spin out and go in a million different directions, but I think it just becomes core to our mission to make sure we're focusing on providing what's important to the people it's important to, right? So dispatchers are kind of interested in a different thing than maybe corporate sales exec. As a maintenance technician, as a small owner operator trying to maybe invest in a couple different trucks. So we've already started to have discussions. I think it needs to be a point of focus for us throughout the year, regardless of what happens, to make sure we're targeting that message and focusing on what's important. It's very easy to sensationalize. And again, just to compare and contrast rising versus falling markets in any industry, people fall victim to sensationalizing crashes more than they do spikes, right? It's just the way that it is. So I think even if we start to see correction back to normal this year, which we're all pretty much in alignment predicting, some of us more or less than others, there will be that tendency to start talking about things like crashes and steep declines and business failures. And I think it's going to be really important if we do get to that point where the market starts going back down, to realize where it's coming down from, why it's coming down, and the levers you need to pull in your business to make sure that you're still operating profitably and effectively. I think that's my soapbox for the kick off the year in the freight insight space. Anything to add?
Yeah, I would, Ken. I think it's always important to weigh information on your own scales. It's always been good advice to me when it comes to data. But I think the key thing, and this is sort of based on some of the pundits in the industry making very wild claims on very small data sets, I think it's really important to understand that we're talking from a very deep data set that covers a big chunk of the industry, both in the spot and contract market. So our market intelligence is pretty well founded, and I think that's an important point that gets overlooked when we start talking about this, because there's so much noise out there in the media circles. It'd be easy to get distracted and think that the market's going in a particular direction, someone making a point based on very little information. It's a big difference in terms of the breadth of data that we've got and the number of loads we're moving each day.
Yeah, I was hoping to get out of January without going there, but yeah, we have more than a dozen contributors. I think we ended the year. We'll be ready to share sometime in the next couple weeks, once our SQL jockeys are back ready to go and caffeinated. We'll do our deep dive on how 2021 shaped up, but I wouldn't be surprised if we don't tip over $120 billion worth of paid freight transactions coming in nightly. Something like 1,200, 1,300 contributors, leveraging the full power of the combined FMIC and DAT databases and contributor networks. So this is the year to take action on that, though. Is I guess the point I was speaking to before. It's like it was like a build year for us on our analytics side. This is going to be kind of like the unleash year, I think, on a lot of different things. We can't share too much, but I know Ned's sitting on a code complete game changer of a product. So
it's pretty spicy.
Yeah, I'm really excited for what this year is going to entail in our world. It's hard to believe I've been doing this for 2 years now on this side of the industry, so it's going to be a really interesting third year. All right, questions. We'll quit talking.
Questions.
All right. Mirza Begovic, is it better for this market year to have more customers, because my expectation our rates will go down in the second quarter? This is echoed by Ellen Humphrey, or kind of semi-echoed by Ellen Humphrey. Do you still anticipate the new normal to come to fruition in Q3? I recall you saying that you thought it could happen maybe closer to Q2. Just curious if you'd chase your opinions. I feel like we said, I feel like Q2 was more like mid Q2 was more what people were saying than Q3.
Yeah.
For this year, for a downturn. But to get back to like Mirza's initial question, more customers as like a hedge against like volume as a hedge against price fall. What's your opinion on that?
I mean, it's kind of a hard. So I'm trying to parse that semantically. I mean, I think almost undoubtedly, I know that's kind of a cop-out set of words, but there is going to be a volume shift back to contract. We're already seeing a lot of the telltale signs of it. That's just the way markets work, right? So the big shippers, the big carriers will continue to move price up, right? So you have the supply and demand. They're going to continue to move prices up until such point where they're adequately supplied on the contract side.
Right.
They are in a very uncomfortable market position. So take like the emotion out of it. Take like the kind of non-fundamental pressures out of it. Having this much freight in the spot market is not an equilibrium point for how like the entire transportation apparatus is designed, right? It's designed to have roughly 80-20, 85-15 split between contract and spot. It's just the way that it works, right? Or else you'd have to see the entire trucking industry flip, where like every truck on the road is a different company. You don't see the Schneiders, Swifts, Knight Swifts, whatever, all down the road, right? So I think that those market pressures are inherent. They're not just going to like go away, at least not anytime soon. So as that starts to shift back, the spot market will lose customers in that sense. It will drive volumes down. And it remains to be seen how much it drives rates down, because those things don't necessarily move one-to-one in concert. There could be systemic hedges that have been put in place as a result of COVID, due to inflation, due to the cost of doing business, due to just a number of things we could spend hours talking about. So things will move. They'll probably start moving in the second quarter, I think, almost undoubtedly. What there's a lot of debate around right now is like, does this inflection look like the Appalachians or the Rockies, in the sense of like, are things just going to start, like, we're going to do 52 shows this year, 50 shows this year. Are you going to hear us talk each week about, oh, things are starting to crest, they're coming down a little bit, or are we going to be talking about like, oh, this 2 to 3% per week declines would be indicative of like a Rocky Mountain kind of shape, like a 2018 shape? So those are the things that we don't have clear view on. But sometime in Q2, Q3, that contract marketing exerting its force, new capacity coming online, should very well, in theory, start to bring things down. How sharp it is I think what a lot of people are asking, and we just don't know what that's going to look like yet.
Yep.
Stephen Linton comments, I tend to believe that if the current weather pattern continues, the short-term and blended models may be more accurate. Thoughts? I sure hope not. I don't think that you're wrong necessarily. I just like that. Those are some pretty aggressive rate increases in a market that's already like very, very wild.
I mean, locally, that could be the case.
Yeah.
I don't know how much. I do know. I mean, the market in Kansas City is not going to be as impacted by what's happening in DC and Philly and all that. I mean, I don't.
Right.
I don't see it disrupting any different than a hurricane would. And even then, I mean, hurricanes blow houses over, snow melts.
Yeah. Yeah.
So I sure, maybe over the next couple of weeks it could put added pressure on top of returns and clearing congestion, but I don't know. I guess I'm not as concerned outside of like the actual impacted areas.
Yeah.
But I've been wrong before. Might as well get the first big one out of the way in 22.
Jordan Brooks asks, I am a brand new broker and I just got a few job inquiries and I need to know more about freight lanes and rates. Well, you've come to the right place. What would be a good price point on DAT for me to join? I would love to know more about DAT. Jordan, can I get you to send your email address, please? Send an email to askiq@dat.com, and we will put you in touch with folks who have their entire job is explaining the various packages and what you can expect out of various tiers of DAT experience. I will say that we have very good lanes and rates data, remarkably so. And we also have a number of powerful supply and demand tools that are available. And depending on where you are and what your price point you're comfortable with, go for that. I'm kind of curious about the job enquiries though. Is this your shippers are reaching out to you and you're trying
Right.
to find like a good yeah.
It's right. Yeah,
Yeah.
for sure.
Any other comments?
No, I mean, again, if you're kind of an agent and you're kind of fielding different opportunities, a lot of times you have to bring BYOS, right? Bring your own subscription to DAT, and others pay for it, right? As part of like your agency agreement. So yeah, go ahead, drop us a line at askiq@dat.com. We'll get you in touch with the correct parties. We don't lie to you when we say we're not in sales here. It's not like some thinly veiled like elbow around the table. Like I think if you really quizzed Ned, Dean, and I, we probably couldn't even list all the packages that we offer for all the different customer segments. So again, we're here pretty honestly just trying to like convey the market stuff and analytics and whatnot.
Right, exactly.
That might be a fun show.
Yeah, we should do that. I mean, I just to kind of like humble ourselves and try to do the job of like, because I have tremendous respect for our customer support folks because they can rattle on stuff that I didn't even know we still did lane credits for contributors, right? I was like, I didn't know that.
Get like Kathy Martin in here and quiz us on various packages, inside sales packages.
That's funny. That would be hilarious. Anything else?
That's it for the questions. Unless I missed something, which I didn't.
Keep up the ball.
I think we're good for shout outs then.
Yep.
So I have a big one. I'm going to go a little break the mold a little bit here before Dean gets into his stuff. So DAT had a really great year in 21. A lot of folks in the freight industry had a really great year in 21. I think everyone knows that hiring is an interesting practice in the time of COVID. We have a ton of really great positions that we just opened up. We're hoping to get 22 off on the right foot in terms of hiring. Again, a lot. What are you pointing at, Ned?
I'm trying to like underline your point, but it's hard because everything's mirrored, and I'm not exactly sure.
Yeah, so again, new year, we run on a calendar year. A lot of these positions we just opened up the requisitions for. I'm going to be really taking a heavy hand in recruiting in the first quarter of this year. We have, like I said, a lot of really great, really fun, really cool positions, whether it's data scientists, product managers, user experience designers and leadership positions, strategy positions, product marketing positions. And again, it's spread across 2 different headquarters. We're in Denver, we're in Portland. We have remote opportunities. In particular, I'm really going to kick the year off. We're looking for a new product director in our IQ space. So what we do here and senior product managers. So if you're interested or have experience in that field, you can do Ask IQ. You can go to our website. Anyway, get a hold of us on LinkedIn. It's an interesting time in our history where like our success is going to be largely developed or determined by the getting the right people in the right seats to sustain this growth. So I can't plead with everyone listening enough. If you know someone who might be interested, if you or yourself are interested to come join our team, it's a great place to work. We have a ton of fun, and we get to play with the best data in the industry. So please drop us a line if you're interested, and we'll get you in touch with the right hiring manager for that particular role. So that's my plug for the week.
So we split the referral bonus 3 ways, right?
I'm actually not eligible for referral bonus.
You're not eligible. Okay, 2 ways. Dean?
But I will gladly split it. I'll cut the cake for you two.
Okay.
Dean?
This week I'll be on Landline Now, 7 p.m. Eastern, Wednesday evening. That's tomorrow night on Sirius XM channel 146, the famous Road Dog channel.
Cool. I think that's really all we have in terms of plugs. Everyone's at easing into the year. We'll have more information about trade shows and where we'll be appearing and all that kind of stuff as we get through the first couple weeks of the year. So with that, I will sign us off. We will be here next Tuesday at 10. And that's it. I hope everyone has a great start to their new year. Be safe out there if you're in the weather impacted areas, and we hope to see you back next week. Have a great week, everyone.
Thanks, everyone.
Bye all.